3 out of 4 stocks follow the general trend of the market, and the best opportunities always come when a bear market ends. The question is, how do you know when it's safe to start buying stocks again? In this lesson, we're going to talk about the follow-through day as one way to get the all clear. While the market is in a downtrend, you are waiting for the first day the market closes positive to start a running count of days for an attempted rally. The first positive day is day 1. You can also have a pink rally day, which is when the index closes down on the day but closes in the upper half of its range. We'll go over an example of that shortly, but this can also count as a day 1. Once we get to day 4 or later, we can start looking for a follow-through day, which is a gain of 1.25% or more on an increase in volume from the previous day. Not every follow-through day works, and it's not uncommon to have multiple attempted rallies and failed follow-through days before the market finally begins that new uptrend. But no bull market has ever started without a follow-through day. So let's go ahead now and take a look at some examples. Okay, so here we are in this clear downtrend and we get our first positive close. So we'll start our running count with this being day 1. From here, if the low of day 1 is undercut, we will need to start looking for a new day 1. But until then, this is the start of our attempted rally and we want to be watching for a follow-through day on day 4 or later. So we can fast forward and on day 6, we get our follow-through day. The Nasdaq was up over 2% and volume was higher than the previous day. Moving ahead to day 7, we also got an additional follow-through day. This time, the Nasdaq was up 1.8% and again, volume was higher than the previous day. So we had back-to-back follow-through days. This rally went on and ran higher, but ultimately failed by coming down and undercutting the lows from day 1. So now that the lows were undercut, we would begin looking for a new day 1, which we got a few weeks later in the form of a pink rally day. So the pink rally day, despite the Nasdaq being down, closed in the upper half of its range, so we can count that as our day 1. 4 days later, on day 5, we staged our follow-through day. The market was up over 2% on volume greater than the previous day. One thing to note here is that even though volume was well below average, it was still higher than the previous day, so that still counts as a valid follow-through day. Similar to the last rally attempt we looked at, this one also had an additional follow-through day the very next day, and this one was powerful. The Nasdaq was up 4.5% on volume well above average. Okay, so now we've covered how to get back into the market using the follow-through day. Now let's go over distribution and how to get out of the market and avoid major corrections. The first thing we're going to talk about is a distribution day, which is a day when price is down 0.20% or more on volume greater than the previous day. These are fairly straightforward and they're easy to spot on the chart. However, there is a trickier form of distribution known as a stall day, which is when the indexes are actually positive on the day. However, they do not make any further upside progress and volume is heavy, showing churn or hidden distribution. These normally happen near the highs. Both distribution days and stall days by themselves can serve as a warning to start paying extra attention to the market direction. But when you start seeing distribution clusters or multiple days of distribution and stalling within close proximity to each other, the alarm bells should be going off and something bad could be in store. Let's take a look at some examples. Okay, so here's that same day 6 follow-through day we looked at in the last lesson that ultimately failed. So let's see now how you could have avoided further downside. Our first warning came on this stall day here. We're right near the highs, which is typically when you start seeing these. So for this one, the market was up 0.15% and volume was higher than the previous day. You can see at one point during that day, the market was up much more than that, so this closed right near the low of the day, showing distribution. Fast forward a few days later, and there's a big distribution day. This one is very obvious. It's easy to see. The market was down 1.74% and volume was greater than the previous day. Moving on, just 2 days later, we get another distribution day. The market's down another 1.75%, and once again, volume's higher than the previous day. So at this point, 2 of our last 3 trading days have been distribution days, and we had a stall day as well. 3 days later, there's another distribution day. This time, the market's down 1.9%, and the distribution days are really starting to pile up. 3 out of the last 6 trading days have been distribution days. Not only now are we starting to see a cluster of distribution, but the index is also below its 21 exponential moving average, which is this green line. If you look at the previous rallies, when the index is healthy and in an uptrend, it tends to be above that 21 exponential moving average. So now we've closed below that on top of having a cluster of distribution. But let's fast forward 2 days later, and there's yet again another distribution day. The market's down another 2.46%, and then 2 days later, the low of the follow-through day is undercut. So you can see there were clear signs of distribution. There were warning signs that you should have been getting out of the market, going and selling stocks that weren't working and locking in profits on the stocks you did have that were working. Now that we know what follow-through days are and how rally attempts work, as well as distribution, let's go ahead and put it all together. Okay, so here we are, day 1 of our rally attempt. Let's move on to day 6 and we get our follow-through day, plus an additional follow-through day the very next day. Jumping ahead a few weeks, we get our first sign of distribution with this stalling day right at the highs, and then from there, we get a really nasty distribution day right off the top. 2 days later, we get another distribution day, and then just a few days after that, we get yet again another distribution day, and this one breaks below that 21 exponential moving average as well. So at this point, we have a distribution cluster and we're below the 21 exponential moving average. You should be thinking about locking in any profits you have and selling anything that showed you a loss if you hadn't already done so. Okay, let's keep going. 3 days later, we see more distribution. And then here, we break the lows from the follow-through day. So at this point, we have 5 distribution days plus a stalling day, and we are below that 21 exponential moving average. While technically the rally only fails if we break below the low of day 1, with this much distribution and being below the follow-through day lows, to me, this rally attempt is dead, and it's time to begin looking for a new day 1. The very next day, we do get a new day 1, and then 9 days later, we get a brand new follow-through day. This one quickly fails though. You get a distribution day on just the 3rd day after the follow-through day, and we undercut the follow-through day low. Let's move on now. Skipping ahead, 3 days later, we undercut both the new day 1 and the day 1 of the previous rally attempt. So now, even if you weren't convinced before that this rally is officially over, this time it's over. It's time to start looking for a new day 1. Okay, so here's our new day 1, and then we get a day 5 follow-through day. Unfortunately, just 2 days later, we get a distribution day. However, this one didn't just roll over, we actually got an additional follow-through day on day 16. Once again, this was quickly met with distribution just 4 days after the last follow-through day, and then 2 days later, you get a very ugly distribution day. The Nasdaq drops close to 5%, breaks below the 21 exponential moving average. 2 days later, another distribution day, and we undercut the lows of the day 5 follow-through day. Another distribution the next day, and then the following day, the rally officially fails when we undercut the day 1 lows. The very next day, we get a pink rally day 1, and 4 days later, a day 5 follow-through day. We get an additional follow-through day the very next day, but we are quickly met with distribution once again. The market, however, recovers and makes its way higher for a few days, and then there's another distribution day. Once again, the market shrugs this one off and it pushes higher. This time, we don't see another distribution day for many weeks, and during that time, look at all the accumulation going on with these above average blue volume bars. This ended up being the low for 1998. So you had failed follow-through days, but if you were vigilant and paying attention to the distribution days and clusters and stalling days, as well as if the index was above or below that 21 exponential moving average, you would have been able to navigate this difficult environment without losing too much money and getting back in on the long side just 4 days off the bottom. Thank you for watching. If you enjoyed this video or found any of the information useful, please go ahead and hit that like and subscribe button so you don't miss any future updates.